Okay, let's dive right into this explainer and make sense of the absolutely intense volatility rocking the Indian equity markets over the last few months. If you've been glued to the tickers lately, you know exactly the kind of whiplash I'm talking about. We're going to unpack the underlying forces driving this roller coaster, looking at the actual pre-market reports and data sets that the pros wake up to every single day. So if you've been sitting there scratching your head wondering why we keep seeing these sudden drops despite really strong domestic growth, well, you are definitely not alone. One day, the market catches a nice relief rally, and literally the very next day, a sharp sell-off just wipes those gains completely off the board. It's a classic tug of war, and today, we're going to figure out exactly who's pulling the ropes. To make sense of this fragile momentum, we'll break this puzzle down into 5 parts. 1. A market in tug of war. 2. The institutional battleground. 3. Global markets dragging down. 4. Oil, gold, and geopolitics. And 5. The verdict for investors. Let's get to it. Starting off with Section 1, a market in tug of war. You know, the daily reports we look at constantly reference the gift nifty. Think of it as the market's early morning weather forecast. And lately, well, it's basically been calling for heavy rain. Almost every update points to the gift nifty signaling these gap down or muted openings, which immediately sets a defensive, super cautious tone right out of the gate. Day after day, we are seeing outlooks projecting a negative note, tracking weak global cues before the actual trading even starts. And, you know, when the starting line is constantly being pushed backward like that, maintaining any kind of upward momentum becomes nearly impossible. Moving on to Section 2, the institutional battleground. The sheer scale of this daily battle is honestly fascinating. On one side, you have foreign institutional investors, or FIIs, aggressively and consistently pulling their capital out of the Indian market. But on the exact opposite side, domestic institutional investors, or DIIs, are acting as this stubborn, relentless cushion, just stepping right in to absorb that immense selling pressure. Let's look at the hard numbers for a second to put this in perspective. By late May, FIIs had pulled out an astonishing 2.27 lakh crore rupees for the month. But that foreign exit was matched blow for blow by DIIs, who injected 2.59 lakh crore rupees just to hold the line. Zooming out to the year-to-date figures, domestic funds have literally poured over 3.32 lakh crore rupees into the market. I mean, it is a monumental standoff. And this isn't just some occasional dip. We're frequently seeing FIIs selling for 6, sometimes 8 consecutive trading sessions. This relentless foreign exit is exactly why the markets have stayed so tightly range-bound. It's kind of trapping the domestic momentum, despite having deep pockets and a ton of optimism at home. Let's look at Section 3, global markets dragging down. So the absolutely crucial point here is that India isn't operating in a vacuum. We're seeing sharp sell-offs in the US, major anxiety over tech and AI valuations, plus this ongoing nagging uncertainty around the Federal Reserve's interest rate policies. Add broad inflation fears to that mix, and you essentially have a perfect storm of global anxiety just dragging everything down. As you can see, this broad weakness across Asian and US indices has created a distinctly risk-off environment. When large global funds decide it's time to play it safe, they systematically pull their money out of emerging markets, like India, mainly to go park it in safer, more traditional assets. Next up, Section 4, oil, gold, and geopolitics. First off, we have our primary catalyst, escalating tensions between the US and Iran. The source reports detail a really volatile situation, fluctuating wildly from, hopes of draft ceasefire agreements one day to reports of fresh military action the very next. This constant back and forth creates profound uncertainty in the Middle East, and as we all know, markets absolutely hate uncertainty. This instability directly triggers our second catalyst, which is crude oil. Because India imports the vast majority of its oil, uncomfortably elevated crude prices act as a massive headwind for the domestic economy. It instantly sparks inflation concerns and weakens the currency. And finally, as investors panic over rising oil and geopolitical conflict, they flock to our third catalyst, gold. We're seeing gold prices inching higher and higher, which reflects massive safe haven demand. Basically, when the world looks dangerous, money runs to gold. This shift away from equities and into safe havens is exactly why those foreign funds are selling off Indian stocks right now.
Right now, commodities like gold and crude oil are hypersensitive to geopolitical developments. They're reacting instantly to literally every rumor of a ceasefire or a new military strike. And as these commodities swing wildly, they end up dragging equity markets right along with them.
And finally, Section 5, the verdict for investors. The overarching narrative of the last few months is perfectly captured right here in the reports. Persistent DII support continues to cushion downside pressure despite FII selling. Think about that. Domestic funds, fueled by everyday retail investors through mutual funds and SIPs, are basically acting as a massive shock absorber against a relentless barrage of foreign exits. It is quite literally domestic optimism fighting global pessimism. Which leaves us with one critical question to ponder today. In this incredibly high-stakes tug of war, will the weight of global pessimism and rising oil eventually snap the rope? Or will the unprecedented resilience of India's domestic buyers actually win the day? The answer to that question will define the next big market move. Keep a close eye on the numbers, and we'll see how this all plays out.